Welcome to the deep dive. We're here to cut through the noise, basically give you the insights you need without the fluff. You want the shortcut to crucial knowledge, right? Well, that's what we do. Today, we're jumping into European passive investing, a beginner's twin engine guide. Our mission, as always, is to pull out the absolute core ideas from the source material, give you a solid, actionable grasp of this approach.
And we're definitely focusing on the practical side today, looking at how an experienced investor actually builds wealth with passive investing, specifically here in Europe. So you can expect us to get into the core principles, yes, and the steps involved. But maybe more importantly, we'll look at why these strategies work so well. And, touch on some of the, let's say, real-world complexities and maybe some unique advantages in Europe.
Yeah, that focus on the why, I think that really helps deepen the understanding for everyone listening. Okay, so the source material kicks things off with this pretty interesting analogy. It contrasts single-engine and twin-engine investments. Sounds intriguing. What exactly are we talking about here? And why is this distinction apparently so critical for, building wealth that lasts?
It's a great analogy, actually. Really helps frame the whole philosophy. So single-engine investments, according to the source, are generally speculative. They're almost entirely focused on the price going up. Think buying maybe a rare collectible, hoping it becomes more valuable, or maybe a really volatile stock you plan to sell quickly. The risk is often higher, right? Because your whole potential profit depends on someone else paying more later. There's no ongoing income from it.
Right, no cash flow, just waiting for that price jump. It
Right.
sort of taps into that desire for a quick win, which, let's face it, can be tempting for new investors.
Oh, absolutely. And that's often where the trouble starts. Now, twin engine investments, they're different. These are presented as the real wealth generators. The source points to things like real estate and stocks. The key thing is the dual benefit. They offer potential price appreciation and consistent cash flow. So with property, maybe the value goes up, plus you get rent, right? With stocks, the price might increase, plus you could receive dividends. And that steady cash flow is highlighted as, well, a cornerstone of building wealth sustainably. For European investors especially, having those two streams can be really valuable. Gives you flexibility, a bit of cushion.
Okay, that dual aspect makes a lot of sense. It's not just betting on price, it really reframes things, building long-term wealth versus just trying to get rich quick. Emphasizes sustainability. So understanding these twin-engine assets is step one. But how do we actually do this in the stock market? Because when people think stocks, they often imagine, picking individual companies, watching charts all day. Is that really the best way for most people?
Well, what's fascinating is how the source material really pushes back against that idea. The truth is, active stock picking. It's incredibly hard to do well consistently, especially for individual investors. I mean, you're trying to beat professionals who have huge teams, tons of data. The source mentions that historically, something like fewer than 20% of active funds manage to beat their benchmark index over 10 years. If the pros struggle, well, you can imagine the odds for an individual. It's tough.
Wow, less than 20%. That's sobering.
It is. And beyond just the difficulty, there are all the psychological traps,
Yeah.
getting attached to a stock, following the crowd, panicking. The source definitely makes a strong case that picking individual stocks consistently is, let's say, challenging.
Okay, so if playing stock market guru is likely a losing game for most of us and kind of stressful too, what's the alternative? What does the guide suggest for long-term growth?
Right, and that's where index funds and exchange-traded fund ETFs really come into their own. The source presents these as, frankly, a superior option, much more accessible and effective for the average person wanting stock market exposure. Instead of trying to find the needle in the haystack, you're essentially buying the whole haystack. These funds hold a wide range of stocks that track a whole market index, like the S&P 500 in the US, or maybe a European one like the SATOXX Europe 600. That broad diversification cuts down risk massively. You basically aim to match the market's performance. And something particularly relevant here in Europe is the role of UCITS funds.
Ah, yes, UCITs. That term pops up a lot for European investors. Maybe quickly unpack why that's important.
Sure. UCITS stands for Undertakings for Collective Investment in Transferable Securities. Bit of mouthful. Basically, it's an EU regulatory framework. It means funds labeled UCITS follow strict rules designed to protect investors. They have requirements around transparency, how easily you can buy or sell them, liquidity, and diversification. It makes them pretty reliable and popular across Europe. Sort of a gold standard, you could say. Helps with investing across borders within the EU, too.
Okay, so that UCITS label adds a layer of trust and standardization. That's good to know. So the passive approach simplifies things, avoids the stock picking stress, and UCITS offers some regulatory comfort. But what's the engine driving the wealth creation here? What makes passive investing so powerful over the long run?
Yeah, good question. The power really comes from a couple of key forces. They sound simple, but their long-term impact is huge. First, and maybe the biggest one for long-term wealth, is compound interest, or compound returns, really. When you invest, your returns start generating their own returns. It's like a snowball rolling downhill. By consistently putting money into broad market funds, or ETFs, even small amounts, over decades, that effect becomes incredibly powerful. It's all about time and consistency, not necessarily hitting home runs.
Right, compounding. Einstein supposedly called it the eighth wonder of the world, didn't he? It's amazing how steady, small actions add up exponentially.
Exactly. And the second big advantage is avoiding what the source called the folly of market timing.
Mhm.
Okay. So many people try to guess the market's peaks and troughs, buy low, sell high, but the evidence is pretty overwhelming. It usually backfires. It's incredibly difficult to do consistently. You risk missing the market's best days, and that can seriously hurt your overall return. A passive approach, where you invest regularly, maybe monthly, regardless of what the market's doing, that's often called dollar cost averaging. It generally leads to better results because it takes the emotion out of it. You just let the long-term trend work for you.
Yeah, taking the emotion out seems key. It's easy to say don't time the market, but harder to do when things look scary or overly exciting. This systematic approach sounds much calmer. Okay, these principles make a lot of sense, but let's get practical. For listeners thinking, all right, I want to do this, how does it actually work? How would someone start investing in, say, a European ETF?
All right, let's ground this. The source actually walks through it. The basic steps are pretty straightforward. First, you need to open an account with a broker. That's just the platform you use to buy and sell investments. Make sure it operates in Europe and gives you access to the ETFs you want. Then you fund the account, usually just a bank transfer. Next, you search for the ETF you want, maybe one tracking that STOXX Europe 600 index we mentioned, and importantly, check if it's UCITS compliant for that extra layer of protection. Once you've picked it, you just place a buy order through the platform. Honestly, it's often as simple as buying a single stock, but you're getting that instant diversification across potentially hundreds of companies.
Okay, so open account, fund it, find the UCI's ETF, place order. Sounds surprisingly manageable, less intimidating than maybe people think. But Europe isn't just one single market when it comes to the nitty-gritty like taxes and rules, is it? What else do people need to watch out for?
Ah, yes. That's a crucial point the source raises. While buying might be simple, you absolutely have to understand the local complexities. Tax is a big one. How capital gains are taxed, how dividends are taxed, even things like inheritance tax. It can vary a lot between European countries. And it depends on where you live, too. For example, the tax withheld on dividends can differ based on where the ETS is registered, its domicile, and your country of residence. Some countries have tax treaties that reduce this, others don't.
Right.
And capital gains might be taxed differently depending on how long you hold the investment or specific national rules. Currency is another factor. If you're in the Eurozone buying an ETF priced in Swiss francs or British pounds, you've got currency risk. Your return depends partly on exchange rate movements.
Okay. So currency fluctuations and those varying tax rules across different countries,
Yeah.
they can definitely impact your actual take-home return.
Precisely. The source emphasizes that you really need to research the specifics for your own situation or, talk to a financial advisor who understands these cross-border European issues. It's not one size fits all.
That really highlights the need for that extra layer of personal research specific to your country and circumstances. It's not just picking the fund. Okay, we've covered a good amount of ground here, making this potentially complex topic feel much clearer, I hope. So just to quickly recap the key points for you. We talked about that difference between single-engine speculation and twin-engine assets like stocks and real estate that offer both growth and cash flow, really useful in the European context. Then we looked at why passive investing through index funds and those regulated UCITS ETFs is often a better bet for most people. It gives you accessibility, harnesses compound interest over the long term, and helps you avoid trying to time the market. And finally, we touched on the practical steps of buying a European ETF, but also flagged the really important need to understand your local tax situation and currency impacts.
Absolutely. And maybe a final thought to leave you with. Consider how the sort of simplicity of this passive approach could actually be its greatest strength. By not constantly chasing the market or stressing over stock picks, how might that free up your time and mental energy? Could you maybe reinvest that energy into other twin engine parts of your life? Learning new skills, relationships, health, things that also compound and generate returns well beyond just the financial. Something to think about.
That's a really powerful thought, shifting focus from just financial capital to, well, life capital. Great perspective. Thank you for joining us on this deep dive. Keep learning, keep asking questions, and we'll catch you next time on the Deep